All right, let's get right into it and look at Plug Power. The U.S. market is currently in its pre-market session for Tuesday, October 28, 2025. The stock, Plug, closed yesterday's session at $2.96. As we're watching the early indications, the ticker is showing some slight upward momentum, trading around $2.99, which is a pop of just over 1%. Now, for a stock that has been as absolutely volatile as Plug Power, a 1% move is basically just noise. It's nothing. But the immediate insight here, the thing that most people are missing while they watch this tiny pre-market tick, is the massive, almost contradictory tension building under the surface. On one hand, you have recent reports confirming that the company's Georgia green hydrogen plant is hitting record production levels. On the other hand, Wall Street analysts are in a complete civil war over this stock, with some firms setting price targets as high as $7, while others, like Citigroup, are holding firm on a 0.75 target. This isn't just disagreement, it's a fundamental break in how the market views this company's very survival. We are witnessing a massive disconnect between stated operational progress and extreme financial skepticism. Let's establish the common ground, which is the expectation that has kept investors in this name for years. The general belief, the story you hear, is that Plug Power is the key to the future green hydrogen economy. They are building the infrastructure, they have the technology, and they are synonymous with hydrogen fuel cells. The expectation has always been that this company is just on the verge of finally scaling up, achieving positive gross margins, and solving the complex puzzle of hydrogen infrastructure. Investors look at the potential market: forklifts, heavy-duty trucks, stationary power, data centers, and they see a company that should be trading like Tesla stock was in its early high-growth phase. The clean energy narrative suggests massive government tailwinds, especially with the Department of Energy loan guarantee. If you use a platform like Robinhood or SoFi Invest, the hype and hope surrounding Plug has likely been a constant presence. The story is that this is the ground floor. But that glowing expectation is colliding painfully with the current reality. The reality is that Plug Power is facing an intense and persistent cash crunch. That scaling up part hasn't just been difficult, it's been phenomenally expensive. The reality is that the company is losing, by some recent estimates, roughly $250 million every single quarter. That's an annual loss rate that represents a massive chunk of its entire market capitalization. The government support, like that $1.66 billion DOE loan guarantee, is critical, but it isn't a blank check. It's a guarantee announced back in January, and the specifics of the drawdown and the covenants attached are what matter. It doesn't instantly solve the negative gross margins. The company's own going concern warning from earlier in the year and auditors' official doubt about its ability to stay in business has not been forgotten by serious investors, even as management works to secure new financing. This isn't Apple stock sitting on a mountain of cash. This is a high-stakes bet on operational execution, and the clock is ticking. Let's dig into the recent stock movement, because this is where the battle is being fought. This $2.99 pre-market level is happening against a backdrop of extreme pressure. The stock has been trapped in a vicious downtrend for a long time, and even the recent rallies have been met with heavy selling. The intraday volatility has been staggering. We're talking 5–10% swings on days with relatively minor news, or sometimes no news at all. This isn't investing, it's high-speed algorithmic trading. The trading volume gives us a clue. On up days, the volume is often average, but on down days, especially following any news about financing concerns or analyst downgrades, the volume spikes massively. This suggests strong conviction among sellers. Buyers, meanwhile, appear to be short-term traders and bottom fishers, not long-term institutions building a core position. This is the kind of price action you see on the Robinhood app from users trying to catch a falling knife, not what you'd see in a stable Fidelity wealth management portfolio. The institutional activity is where this expectation versus reality fight is most visible. Recent 13F filings paint a very complicated picture. While some large institutions, like BlackRock and Vanguard, maintain large passive positions, mostly because Plug is included in various clean energy and small-cap Fidelity ETFs, the active institutional sentiment is extremely negative. The short interest in Plug Power remains extraordinarily high. A massive percentage of the company's float is being actively bet against. These aren't small SoFi active investing accounts, these are massive funds that have looked at the financials and concluded that the risk of further dilution or even insolvency outweigh the long-term hydrogen story. They see the company's persistent negative gross margins. It literally costs Plug Power more to produce and deliver its hydrogen and products than it makes from selling them. And they see a fundamentally broken business model that is entirely reliant on outside capital. This is all happening in a tough macroeconomic environment. Higher interest rates have been brutal for companies like Plug that need to borrow heavily to fund their growth. When a Fidelity mutual fund manager or a Schwab Intelligent Portfolios algorithm has the choice between a U.S. Treasury bill paying a solid risk-free rate or a speculative cash-burning growth stock with a going concern warning, the choice is simple. The cost of capital has choked the entire high-growth, no-profit sector. This volatility is why many long-term investors who might prefer the stability of Fidelity investments simply can't stomach holding Plug in an individual brokerage account. They might use the Fidelity mobile app, check the price, see it's down 8% on the day, and just decide the stress isn't worth the potential. This contrasts sharply with a stock like Nvidia stock, where despite volatility, there is underlying profitability and massive free cash flow. Plug has neither. So, what does Plug Power actually do to burn all this cash? The core business, its legacy, was hydrogen fuel cells for forklifts in large warehouses. They're GenDrive units. Customers like Walmart and Amazon use them. This was their bread and butter, the razor. The expectation was built on expanding this. But the company's massive, expensive pivot is to become a vertically integrated green hydrogen supplier. That means they not only want to sell the fuel cells, the razor, but also produce and sell the green hydrogen, the blades. This is why they are spending billions to build massive production plants, like the one in Georgia. It's an incredibly ambitious, capital-intensive attempt to control the entire supply chain. The good news, as of September, is that the Georgia plant is reportedly hitting record output, producing over 320 metric tons in a month with high uptime. This proves the technology can work at scale. The question is whether it can work profitably. Let's look at the future outlook, framing it through this tension. The bullish scenario, the expectation, rests on two critical pillars. First, the successful and more importantly, profitable ramp-up of their green hydrogen production network. If the Georgia and Tennessee plants can consistently produce hydrogen at a cost that allows for positive gross margins, everything changes. This would finally prove the integrated model works and the cash burn can reverse. Second, the full utilization of that $1.66 billion DOE loan. If they can draw down that capital, it solves the immediate liquidity crisis and buys them the time they need to scale. In this scenario, the massive short interest would be a liability for the bears, and we could see a violent short squeeze. This is what the H.C. Wainwright analyst, with his $7 target, is betting on. The bearish scenario, the reality check, is far more grim. This is the scenario that the Citi analyst with his 0.75 target is modeling. In this reality, the production ramp-up continues to burn cash faster than it generates revenue. The negative gross margins persist because the cost of production and logistics remain too high. The DOE loan might get tangled in red tape or come with covenants so restrictive that it only serves to pay off old debts rather than fund new growth. In this reality, the cash burn continues until the company is forced once again into highly dilutive financing, selling massive amounts of new stock at these crushed prices, which would be devastating to existing shareholders. This is the path to the stock becoming a penny stock. This is the risk that sophisticated traders on the Interactive Brokers platform are betting on. For them, the high volatility is an opportunity, and the Interactive Brokers fees are low enough to make high-volume trades on these swings. This isn't a simple investment. It's a binary bet on survival. It's